So a lot of people are saying that a 6% mortgage rate is killing buy-to-let, but I'm still making it work, and so can you. In this video, I detail how I borrow at 6%, how we ought to structure deals and generate strong returns. Now, very important, make sure you watch this video all the way through to the very end, because not only am I disclosing the solution and sharing the solution with you, but we're going through a real life, real world example, a recent property purchase where we're borrowing at 6%. I'll share all the numbers with you, and then you can decide if you resonate with my strategy and if you also believe and are of the same opinion that buy-to-let still works at 6%. Hello and welcome back to the Property Pilot channel. For those of you that don't know me, I'm Marco. I'm a portfolio landlord, property investor, developer and mentor, and as you can probably tell through watching my various videos, I'm very passionate about residential property and helping people invest in residential property. Now, a quick shout out before we get into the main part of this video. Well done again to Reese and Lindsay, clients of mine, mentees of mine, who have completed on the purchase of their second buy-to-let property this year, and they're on track to clear over £100,000 profit from those two purchases. So well done again, Reese and Lindsay, you're doing an absolutely fantastic job. So before I talk about a solution here, and we'll go over a real example with the figures, I need to just paint a picture of where the problem lies and perhaps common misconceptions. So we'll spend about a minute here before we jump straight into the solution. And this is a really important part of the video. So higher interest rates are scaring some investors away. There's no doubt about it, right? And yes, some deals don't work at the 6-7% mark, but are rates really high? Well, if you look at a 50-year long-term average, you'll find they're not. In fact, they're actually below the 50-year long-term average right now. As I'm recording this video, we can get a mortgage certainly south of 5%. You know, I'm talking about 6% in this video, again, just for a bit of buffer, for a bit of contingency, and if rates do rise in the short term, I don't think they will, but maybe in the long term, you know, there's a reasonable chance that's going to happen, right? So let's have a look at what the problem is. You know, rates are higher in relative terms compared to the past 10, 15 years when rates were peanuts. In fact, I've still got a mortgage on around 3% that's coming up for expiry soon. You know, let's recognize that those glory days are well and truly gone. I don't think in the short to medium term, we're going back to a scenario where we can borrow, say, between 2 and 3%, where the base rate was 0.25 or 0.5%. I mean, that was absolutely incredible. I don't think we're going back to that era anytime soon. So if we're not going back to this type of era with really cheap debt anytime soon, we need new strategies to survive and to thrive in property. And before I share that solution, let me just dispel some myth and common misconceptions around rates. You know, there are a lot of people that saying deals don't work at 6%. Well, actually, deals do work at 6%. Yes, I'm conscious there are some that don't work at 6, but a lot of them do, and you'll get a flavour for what a good deal could look like very, very shortly in this video. Again, another misconception is it's impossible to cash flow at around 6%. That is completely false. And finally, an opinion is that only cash buyers can really operate in this market because they're not paying a mortgage. Again, that's completely and utterly false, because the example I'm about to give right now dispels all those three, because A, we're not buying with cash, B, we are borrowing at 6%, and C, there's a very strong, positive, healthy cash flow in this deal. So let me describe the solution before we go over the real world example. So the solution is as follows. What we can't do is buy any willy-nilly buy-to-let at market value, give it to an agent and let it out. Yes, we'll actually still probably be in positive cash flow, but it's not going to be very exciting from a numbers point of view. Okay, so what is the solution? Well, twofold. We want to be buying buy-to-let property at a strong discount, you know, strong discount to the market value, but we want to be buying buy-to-let property that yields well, or at least, you know, in average. What we don't want is we don't want to be buying buy-to-lets at market value with poor yields, because then all of a sudden this strategy doesn't work. It's not very appealing at lending rates at around 6%. But flip that on its head. If we can be getting remarkable discounts and we're buying high yielding or at least average yielding properties, there's a double whammy here, double whammy effect. First of all, because we've bought the property at a discount, we're locking in significant equity, which we can do something with in the future, or at least the short term. B, if we're buying average or high yielding property, that really incentivizes us to hold on to this particular asset in the short to medium term. It gives us a reason and a reward to hold on to this asset, which is really important and really crucial. So when we combine buying buy-to-let property at a discount, but also buying average to high yielding buy-to-lets, this is what I call the hybrid version of the buy-to-let strategy. One that really resonates with me, one that I practice and preach on a daily basis, and certainly one where I help my clients and mentees profit from. So let's go into a real world example of this. This purchase actually only completed last month as I'm recording this video. So a very great example to go over that really ticks all the boxes. And really importantly, this is a realistic opportunity, right? This isn't a kind of, huge, incredible discount that really, relies on impossible probability to make this happen. My clients who purchase this particular property, they don't work in property, they don't have those internal connections where, yes, they're going to come across really good deals. So I suppose what I'm trying to say here is anyone can generate such opportunities. They don't have to work within the property sector to generate these opportunities. Now, yes, I certainly help my clients out here. I identified this deal for them and pushed it their way. And that's the benefit of, I suppose, working with someone like me. But what's really important is I shared this opportunity on the email list. So if you're not on the email list where we share incredible property opportunities to purchase, please do sign up. The link is in the description. So what is this property? This is a 3-bed terrace property in a good area of Leeds. Now, this isn't your typical terrace property when you kind of envisage and think of buy to let. This is actually more of an owner-occupier type property, and you'll see that reflected in the purchase price. So this is a very nice 3-bed terrace property, one that needs no work doing whatsoever. It's ready to let out. Happy days. So the purchase price, which we agreed, was £230,000. The market value was £275,000. So you can see a significant discount to the market value, a £45,000 discount my clients have obtained. So let's go over perhaps what they could expect rental wise and work out some math. So in its current condition, which is perfect and given current supply and demand in the area, that property will rent for about £1,300 per month. However, really importantly, when I'm assessing a deal, I look to assess that deal over the number of years I'm fixing that mortgage for if I'm buying with a mortgage. And this property was bought with a mortgage. So I'm going to be really conservative. I'm going to take a 5-year average over holding this property for 5 years. And I've allocated a rent of £1,400 to account for rental inflation over the subsequent years. And this will make a bit more sense when we come onto the math very, very shortly. So you can work out the yield straight away. We're looking at a yield, roughly speaking, of around 7%, certainly with the potential to climb a little bit higher than 7% too. So first of all, it ticks the box. It's a high yielding property, which is great. And that's important because it's going to give us the cash flow we need and the incentive to hold this asset in the short term. Now, before we can work out the cash flow on this property and what it hypothetically is going to give us on a monthly basis, we need to understand how much cash is required to go into this deal, then to work out the mortgage cost. So let's say we're putting down a 25% deposit and we've got other fees to think about, legal fees, stamp duties, solicitors, etc. So if we're borrowing 75%, which is roughly speaking £172,000 at 6%, I'm going to look to my laptop now because I wrote down the number prior, that gives us a mortgage cost of £863. So we know our mortgage cost and we know what that's going to be fixed for 60 months or 5 years. We know the average rent is more or less £1,400, and also we've got to understand the running costs. What are the costs incurred to maintain this property? And for landlords and investors who manage and maintain their own properties, not from a hands-on point of view but from a tenancy and paperwork point of view, I think if you allocate a 10% of your rents as your running costs, I found from my experience that works out more or less about right. So if we deduct say £140 per month and allocate that to the running cost of the property, that's going to be more or less on target. So let's do the math. We've got our rent, £1,400, minus the mortgage cost, which £863, minus our running costs, which is £140, which basically gives us about £400 profit per month through owning and running this property. So that's great. It pays us generously in the short term. That's absolutely fantastic. If we look at this deal so far based on return on capital employed purely from a rental point of view, and this basically measures, we're getting £400 per month, times that by 12 to look at it on an annual basis, but we've put £75,000 cash in the deal to make it happen. Well, if we're just looking at our return based on that cash we've invested, just on the rental income we're receiving, roughly speaking, we're looking at a 6.5% rental return, which is good. This doesn't take into account capital growth, which we'll discuss very, very shortly. So just to recap, before we do talk about and discuss capital growth and how much money we're making on the capital side, this property pays us generously in the short term. It's cash flowing more or less £400 £1,500 per month. It's giving us a 6.5% rental return based on our cash we put into the deal, which is great. These types of figures are good figures, which is going to incentivize us as investors and landlords to hold on to a property because we're getting paid now in the short term. So let's come on to the capital side. Well, we already know we've bought this at a discount. It's worth 275. We've secured it for £230,000. So that's great. We're not actually relying on too much capital growth to make that math work. But let's talk about capital growth. Now, we're fixing this mortgage for 5 years. So a really important question I like to ask myself is, what do I think this property is going to be worth in 5 years' time? Because in those 5 years, we have options. We can either refinance and perhaps pull out some equity, or sell the property and take the equity and reinvest that into a better deal. There are other options available, but it's an important question to ask. Now, I've assumed this property is going to be worth around £350,000 in 5 years. And I think that's a conservative valuation. We're not asking for crazy house price growth to achieve that 350. In fact, we're actually looking rather conservatively. Now, if we believe this property is going to be worth £350,000 in 5 years, and we bought it for £230,000, well, that's a £120,000 gain in 5 years. That's absolutely incredible. That's ludicrous. What an exceptional deal. And this is the second part of this hybrid strategy, where we're buying below market value. And by buying below market value, we're not even reliant on capital growth to profit, certainly on the capital side of this property opportunity. So to recap, we've ticked 2 boxes. We've got a high yielding property. We bought below market value. Now let's go over the final bit of math in terms of percentages of the return to understand how this is a good deal. So once we combine both our rental return and factor in our capital growth, and also the fact we've purchased this property below market value, we can look at our total return, which measures our total return as I've just described. Now, if we plug these figures into the spreadsheet, this is equating to an annual return, not total, an annual return of around 38%. That's crazy. That's just unbelievable. Where on earth do you get a 38% return in life with bricks and mortar, which is far safer than other riskier asset classes? Now, the interesting thing here, if we look at the actual total overall return over those 5 years, it's 191%, again, which is just mind-blowing. It's unbelievable. So for those that think buy-to-let is dead, or perhaps they think that borrowing at 6 or 7% isn't feasible, well, I've just proved it's completely feasible. Not only is it feasible, it's realistic too, even for those that aren't working directly in the property sector. So I seriously want you to consider and think about adopting a similar philosophy where we're buying below market value and we're buying at least average yielding properties, perhaps even high yielding properties. But before we go on to some really important key considerations to think about, if you have enjoyed this video so far, please do consider liking the video. There'll be a thumbs up button where you can just press that icon. It won't pause the video. Genuinely will help promote this video and push it out to like-minded people to yourself. But also an extra request would be to please consider subscribing to the channel. It would personally mean a lot to me if you would take that action. So before we close, we really need to discuss some real key considerations when it comes to investing in property. We're just going to tie this now back to the beginning of the video because we know the problem, we now know the solution, but let's just discuss this in several ways. For those in property, we know that property is a long-term game. It's not a short-term fad, it's not a short-term thing that perhaps you would invest in, and therefore by extension, short-term rates don't really matter. What does matter is long-term, and especially when we're looking at rates, where are the long-term rates going? And as I said, if we look at a 50-year snapshot in the UK, we're well below that average, which is positive and good news for us as property investors. We're operating in an environment that is actually kinder to us as investors, as we're able to borrow below that 50-year average. So let's make use of this environment now where rates are relatively low. It doesn't feel that way because we've just come out of a period where rates have been ultra low, but actually long-term rates are low now. So let's be grateful we're operating in this environment and we're able to profit from, again, being alive and operating a property in the 2020s. It'll be interesting to see what the 2030s hold in store for property. Now, we know property is a long-term game, but another long-term thing that a lot of investors don't think about is rental inflation. Now, as I've already alluded to, when I'm calculating my math, and when, let's use the example we used today, we assumed that we're fixing the mortgage for 5 years and we took an average rental figure over those 5 years. We didn't take today's rental figure because that wouldn't be an accurate reflection of how much money we'll be making over those 5 years. So this is really important. Although our mortgage stays the same, we fix our mortgage at that level, rents increase. increase. So this is an absolutely incredible phenomenon that we need to use to our advantage. We need to be passing on small, regular and fair rent increases to our tenants on an annual basis. And this is where we can build a larger buffer and protect ourselves if rates are to increase, when we're coming up to refinancing in the future. And this is the topic we discuss in the book. And for those of you that haven't purchased the book, you can see it right there. The Essential Rules of Property Investing. The link is in the description, and all proceeds from the book are donated to charity. So to summarize, yes, we can borrow at 6% and make buy-to-let work, and that's by undergoing the hybrid buy-to-let strategy where we're buying at below market value and we're buying properties that are average or above in their yields. Now, if you're still looking for more help, consider working with me on a coaching basis. The link is in the description for you to book your initial consultation. Now, do you have a comment? Do you have a question? Please do comment below. I respond to all comments, or very nice comments and questions in the area below. So we'd love to hear from you. Now, I'm going to let YouTube decide which video to offer you up next, and I'd absolutely love to see you on that very next video. I sincerely wish you all the very best with your property investing journey. All the best.